Hello guys. Hello. Let's wait until some more people will join the stream. Let me quickly let me add some text in the stream here, like starting in 1 minute. Let's wait for some more people. Before, meanwhile, we're waiting. I can talk a little bit about what I'm gonna discuss in today's stream, just briefly, very briefly. And that's basically the FOMC meeting. And today's FOMC meeting will be, in my opinion, very important. Okay, very, very important. Now, in today's update video, I briefly discussed why, but in today's stream, we are going to go in depth about why I think today's FOMC meeting will be incredibly important to watch, and it will have a big impact on the market as well. So if you're going to be watching this FOMC meeting, you will be in front. You will know what probably is going to happen next. So let's just wait like 1 more minute. Let me know who is in the stream. Just say hi and let me know where you're from. Then I can read out your name, and that would be pretty amazing, pretty cool. Then I know who's joining the stream again, because it's been a while ever since we've been doing a stream like this. Like, it's been a month or so. So yeah, let me also turn on the cam. There we go. Yeah, so it's been a month ago or so that we've been doing a stream like this. So yeah, it's pretty fun to do a stream again. Let me know in the live chat where you guys are from. That would be absolutely amazing. But like I've said, yeah, it's been a month ago or so. So if I'm gonna go to live, yeah, literally like 1 month ago. Literally 1 month ago, I have been away. I have been traveling for a pretty long time. I've been traveling for like a month. You can also see it in all of my videos. I mean, if you open up my videos and if you see my face cam like that, well, then you know I'm traveling. I've been traveling also for like 1 month or so, and just all around Asia. It's been pretty cool, pretty fun, and I've just been chilling. But right now I'm back. I'm back home, so I'm able to live stream again. I'm able to make, in my opinion, better videos. Okay, because when I'm traveling, I'm just analyzing. I'm not putting that much effort anymore into the videos. Maybe some of you guys have seen that, but right now I'm able to put a lot more effort into the videos again. So that's pretty good for you guys. I guess. So we have got UK, Bristol. Welcome to the stream. Phoenix, Arizona, right? Netherlands. Love your update videos. Keep it up. Thank you so much. From Oslo, Norway, welcome to the stream, and also India. So yeah, first of all, yeah, we have been absolutely on point. I mean, I just want to highlight it pretty quickly. I do not want to shill all too much. I want to get into what's going to be happening next rather than shilling all of my trades and our performances. But I just quickly want to go over it because, yeah, first of all, this entire bull market has been pretty amazing for us. I mean, some of you, it's always in the comments. I sometimes see hate, but then really, if I go back to my analysis and if I go back to my predictions and my track record, and I just have a look into it again, I like, it's incredible because I've been bullish throughout the entire bull market. Only during the tops, during this distribution phase, I've been publicly very, very cautious about Bitcoin. I have been stating that I was selling my spot holdings, and that was exactly what I was doing. After that, we have topped out, and we initiated the move downside. After that, I did say, boom, relief rally back into the 50 weekly moving average, 200 daily moving average. That is exactly what we got. And I have said, after that relief rally, probably we are going to be headed lower. And that exactly happened. Then, from our level of support, previous resistance turning into support, I have been saying that we are going to be seeing another relief rally with our initial push, with grabbing the liquidity to the downside again, and then after grabbing that downside liquidity, at the lows, we have also been trading. I mean, every single move, we have also been trading it. So yeah, this one was just a very recent trade. We have been longing that liquidity grab from the downside, and we have been trading that. I mean, for the ones that have missed it, I can go to the position history, and there you go, 1 month ago, boom. So yeah, we have also been trading it, exited right over here, and right now I've opened up a shorting position, and this is pretty much the whole reason why I wanted to share that track record, because right now this is my next trade where that I shared in the last couple of days. But also I shared it in hindsight because I beforehand, not in hindsight. I shared it beforehand because I've been sharing while I was exiting my trade that probably even like right over here, I've shared my target and I've said that from off that target I will be flipping short. Okay, so yeah, we have been reaching my target initially, and right now I am flipping short. I mean, I put, I mean, I've been saying that I was gonna short, and I am shorting. I'm actually doing it. Okay, but pretty unfortunate. One order didn't get hit right over here. It was very, very close to getting hit, but unfortunately, it just like look at that, right? That's so unfortunate. But look at that wick; it just barely didn't get hit. It's very unfortunate, but it is what it is. You know, it is what it is. By the way, in the meantime, I would really appreciate it if you guys smash up that like button. That would really help out a lot. Anyways, yes, like I've said, just barely didn't enter that one order right there, but it's okay. It's okay, right? Like I've shared in my recent few videos, it's just very simple for me. Either Bitcoin already decides to move to the downside, and I've got one order. Okay, now I wish to have gotten multiple orders hit, but I still do believe that in the shorter time frames we could still see a bit more new highs getting created. I do still think so, even though the Bitcoin time frames are starting to look very bad. Because we'll go over this a little bit more later. But so we are starting to look pretty bad. Also because of this FOMC meeting, and this is going to be the whole topic of today's stream actually. So, but let me get into this a little bit later. First of all, I do want, and yeah, people usually place orders at round numbers. Yeah, it was a bit of a mistake for me because I knew, should I set it at 76k US dollars? And I was like, because my order now is at 75,999. I knew 76,000 US dollars probably. I mean, if we're gonna get close and peak out at around this level, we're not gonna break through the 76k, and we're not gonna hit my order. So I just set it $1 below. But I mean, every single exchange has different prices, right? So probably on another exchange it did get hit, but this exchange, well, barely didn't get hit. So yes, indeed, it's very true. I should have set my order just a little bit more below, so 75,950 probably. That would have been better, but yeah, that's all in hindsight, right? But that's definitely very true. Usually, orders will not get filled or less likely to get filled if it's at a round number. For example, I also had at the exact Bitcoin bottom over here for my spot order, I set a limit order at 60,000 US dollars exactly. Now, some of the exchanges it did get hit. For example, 2bit 5,900, 800, 59,800 US dollars. But for example, on Bybit spot, that 60,000 US dollars barely didn't get hit by a $5 difference. So yeah, that is a good practice to not set your orders at the exact round numbers. Okay, that's good practice indeed. Anyways, going back to my story. Yes, I do still think that Bitcoin is looking somewhat more bearish, and in the coming few weeks, I do think Bitcoin is going to be seeing another push to the to the downside. That is also the reason why I'm trading short right now. Now, in a shorter time frame, we could still dip our toes a little bit deeper inside of this target. That would definitely not be all too surprising to me. In the case that if we were gonna do that, well then, I'm about to open up these orders, and then it's going to be all good for me, right? Now, if we're already moving to the downside now, it's also all good for me. I've already set my orders in place, like a small order, right? But still, we can be making some nice profits from this trade. So it's going to be all good. In both scenarios, going to be all good for me. Anyways, it's just 5 minutes time until the Fed meeting, the interest rate decision will be getting released. So let me get over the info right now about the Fed interest rate decision and also about the FOMC meeting a bit later. And first of all, let's get over the so how it's gonna work is that in 4 minutes time we will be getting the Fed interest rate decision. Now this is not gonna be that exciting because the previous has been 3.75%. Consensus is now 3.75% and forecast is 3.75%. So it and like you can see here with a 99% probability, the interest rates will remain to be unchanged. And if the interest rates will remain to be unchanged, well, nothing major happens, and I mean the market will not really react, right? If nothing happens. So yeah, probably at the interest rate decision release, we're not going to see that much of volatility. But what will be important is going to be the FOMC meeting, which will be live streamed half an hour later. You cannot see it now. There we go, 10:30 p.m. UTC plus 4. So 10:30 p.m. UTC plus 4, 8. Sorry, right? It's Central European time now. UTC plus 1. Anyways, just do the conversion yourself. I'm not quite sure what time zone Central European time is right now. I think it's 8:30 p.m. Right? Anyways, oh no, it's 7:30 p.m. By the way, I'm sorry about that, but. So then the Fed interest, the FOMC meeting will be live streamed, and that will be the most important part. Why will it be the more important part? Because I want to see what Jerome Powell will comment on the US oil prices rising this much. I want to see what Jerome Powell will comment on the inflation, because the US oil prices have been increasing by a lot, okay? And this will cause for rising inflation while the economy is weakening. What will this cause us? This will cause stagflation. So what will Jerome Powell comment about this? Does he also see this as a rise of a concern that's rising? Or does he think everything is all right, everything is okay? And why does he think everything is okay, etc.? Also, what will be his comments on the political things happening? Let's see. Okay, I do not think we will comment on that. But these are definitely things and factors that can get us a lot of volatility in the markets. And we are already seeing a bit of a pre-sell-off before the FOMC meeting. Another fact is that every single FOMC meeting, the last 6 times, let me count it. First, or maybe arguably first time here. Let's count this one as a bearish FOMC meeting. So first one over here, second one over here, third one over here, fourth one over here, fifth one, sixth one, right now the 7th one. Okay, so we have got 6 bad bearish FOMC meetings in a row. After the FOMC meeting, we have seen a bit of a sell-off. Right now we're in the 7th one, and also the stats and the economy isn't looking all that great. So are we going to be seeing this sell-off again? Well, I do think it's going to be pretty likely. History is indicating that at least. On top of that, we have been breaking out of the upper side of the range, grabbing off the liquidity. We have already been hitting my target right over here. So it's going to be all good. I mean, not all too surprising for me if we were to be seeing this push to the downside. Again, not all too surprising to me. We have already gotten our bounce. So yeah, it would not be surprised. I would not be surprised to see that push to the downside. But also, in that shorter time frame, I would still not be surprised to see a bit more of a push. Okay, shake everybody out, break the highs, and then see that push to the downside. The only concern I have with this theory and with this price action that I've drawn out right over here is that it looks very, very similar to the price action that we have gotten right over here. And usually Bitcoin history doesn't exactly repeat, and certainly not the price action of just a couple months ago. Okay, certainly not. Usually something at least is going to be different. So maybe this time around, I don't know what exactly will be different. Okay, I've already explained my theory, I already explained what I'm going to be doing. Maybe this time is going to be different. How it could be different is first see a bit of a push to the downside. then maybe break to the downside of this uptrend, then still get a push to the upside over here, and then see the push to the downside. That could perfectly happen. And in that case, we have still gotten our range with a liquidity grab over here and a push to the downside right after. Okay, so that could perfectly happen. I would not be surprised to see that happening. For me, it doesn't really matter. I've set my game plan in place, and I will be sticking through it. And anyway, if we're going to be moving to the upside now, it's going to be all good. Then I will be entering my orders. If we're going to be moving to the downside now, it's going to be all good. If we're going to be consolidating a lot longer inside of this bigger range right over here, it's also going to be all good, because then probably I will also be filling these orders, but I just need to be a little bit more patient. So oh, by the way, it's already 10. Missed it, but nothing happened, right? Nothing changed. Yes, nothing changed. So yeah, it's maybe some reports will get released with some info. Let me track a financial juice account. Financial juice. So yeah, nothing happened with the interest rates. Maybe there will be a report getting released where some info will be shared at, but I do not think so. Not so some important info, I do not think so. More important part is going to be the FOMC meeting that we will be having a look into live a little bit later in 28 minutes. Meanwhile, if you've got any questions, guys, make sure to ask it in the live chat, and I will be happy to answer. Oh, so yeah, what is going to be the longer term probabilities, predictions? Yeah, so it's gonna be very slow. It's gonna be very slow. Be very slow. We do not want these interest rates being so high. We do not want that. We will experience some interesting times, because for sure I think something else is gonna happen. But we need some major shifts in the world. For example, something needs to break, or US oil needs to dump again to the downside. It depends, right? A lot. But for sure, I do not think it's going to play out like this. Something needs to happen in the world. If this would play out, by the way, it would be... I mean, I do not hope that will happen, you know. If this plays out like this again, would still signal a pretty strong economy. But for our risk on assets, it would not be that good. I mean, I would prefer to see this drop a lot. And that would be amazing. After this recent dump, what is your main case scenario, bullish or bearish? What do you mean? You mean this shorter time frame dump? Yeah, so main case, honestly, in a shorter time frame now, I don't really know. Okay? It's kind of 50-50. I cannot really comment on it. I see us breaking to the downside. Maybe leaning a little bit more onto the bullish side still. Just to shake everybody out. But again, I am biased. I'm still biased because I still want my orders to be getting hit, right? So I am a little bit biased. I've just set up my game plan in the right way, in my personal opinion. And whatever happens, happens. And I think I've set myself in a pretty good spot in the market. And it's more so in the coming few weeks what I care will happen. Not so in the coming few days. So yeah, by the way, guys, for the newcomers, in 24 minutes time, we will have a look into the FOMC meeting. It will be very important to see Jerome Powell's comments on rising US oil prices, what he think will happen next with inflation. Let's actually have a look. What is US oil price? What are they doing? Prices? What are? Let's first have a look at this. Oh, the dot plot. Nothing really happening. It's actually more kind of bearish. But what's to be expected, right? That's the thing. Yeah. Still kind of consolidating here. Nothing much is happening now. So, by the way, for the people that don't know, US oil prices need to come down again for US inflation to be all right. Okay. And we want US inflation to come down because we want Fed interest rate cuts. And if the US inflation will rise again, there's going to be less of an incentive to cut interest rates. It's actually more so than Fed might even look into raising interest rates. So yeah. Hello, AF photo guy. Welcome to the stream. For sure, for sure. I will not stop. Not stop. Maybe after next bull. Maybe for a bit. But right now, nah. Don't think so. Don't think so. Let me know if you're also killing it still in the market. If you're also still active. Because I mean, all of the people that are still active now and watching, I guess, I mean, you're doing literally better than 90% of all of the people out there. I mean, I've already said this before, right? But literally during the peaks of the bull market, I had at the very minimum 10x the views and the live viewers that I have now. Okay, and that's literally 90% left already. They left the market. So yeah, if you're involved now, you're literally doing better than 90%. Because I believe if you stick around long enough in the market, you will make it, and like regardless. That's like my philosophy, and also I've seen it time and time again. So yes, yes. Let me know if you've got any questions, guys. This room is very dark, by the way. Now, I think it's all right. It's also getting bedtime soon. I'm just gonna watch the FOMC after. We'll be headed to sleep. I'm getting kind of tired already, so. Which makes sense. It's already 10 p.m. here. Already 10. Is that Mr. Crypto? Merlin, the trader. Welcome to the stream, man. You are doing well? Are you doing well, my guy? You're not supposed to get a few more drinks in, I guess? It's like that on most channels. Yeah, even the paid subscription channels are totally desolate. Like, it goes down. We'll get good again at 170k. I mean, 170k is gonna take a long time, I think. I mean, it's the sad part is probably it's gonna take a bit longer still, right? Probably it's still gonna take until October of this year. Until then, we will bottom out, and then it will still be boring for about a year or so. Because even when we bottom out, for example, here Bitcoin bottoms out, but still we consolidate, right, for a bit longer. And only after that consolidation of about a year or so, then only it gets exciting. But people will only return like during this part. Okay, so still gonna take a long time for people to return, which is good. I mean, which is good for us, right? Because during these times, you want to invest while nobody is there, while nobody is paying attention. And I mean, I can copy this, okay? Copy it over here. During these times, you want to invest. You want to pay attention. Um, Mr. Crypto, I love your shows. Welcome to the stream, man. Welcome to the stream. Oh, drink in my left hand. Wow, that's great, man. Just do a nice drink. Chug it. Chug it, man. I'm waiting to enter short on Bitcoin to retest 73k. What do you think? I mean, for me, I've already entered my short at 74.8. For me, it's very simple. I mean, I can only comment what I'm doing myself. If we rise again from this moment, well, then I still have orders set up above, right? And these will be my only orders. Now, if we will not hit these orders, well, probably we're going to drop already. And it's going to be all right for me. It's going to be all right for me. I don't really care. Right? I'm going to be profiting anyway. So yeah, that's going to be all good for me. Trades have been amazing. Excited, 70% of positions close to peak. Exited. Nice. Slowly starting to put back now and saving lost bits for around 45 to. Yeah, man. Very good. Very nice. You've been doing well, my man. Good job. Good job. And I'm doing pretty much the same. Should I share? I mean, we are with a small amount of viewers, so I will share it. I don't really care. I'm still like 50% cash and 50% is already in the market. So, and I have the same, like below around the 60k. I'm willing to buy even more and scale in even more. I'm also still dollar cost averaging, by the way. But below the 60k, yeah, I will be scaling in more aggressively with also cash positions. All the way down to indeed around 45, I think maybe 48k US dollar level. And below that 48k US dollar level, like if we were to reach that, I will really have a look into these bottoming out levels. And if we're going to reach these, I will also be opening up some inverse perpetual long positions with like a 2x or 3x leverage for the long term, swing trading positions, right? So that's pretty much the plan. That's the plan. Mr. Crypto, I love your shows. Welcome to stream, my man. I've seen you before, right? Many times. So welcome to the stream again. Fed leaves rates unchanged. Yes, indeed. The Fed leaves. By the way, what's the title? Bitcoin about to break. I'm not sure about the title. It's all right. The title of the live stream. Yeah, sounds good. Yeah, man, I'm very excited. But the only thing is, you just gotta stay patient. It's gonna take like such a long time. And honestly, because it takes such a long time, that's literally the hardest part. Do not do any stupid shit. Like for the next 2 years. I mean, the plan sounds easy, right? The plan to accumulate here, to wait, and for the next bull market. The plan sounds easy, but to actually follow through and stick to it, it's hard. It's hard to like not do one degen gamble trade here just to make some money now, and then to like I don't know buy some stupid stuff maybe with your cash because that's fun. I mean that's the hard part, right? I mean the plan is pretty easy itself, but the hard part is sticking to it. Yeah, not doing anything else. I guess, right? Because already literally now, we're like a couple of months in, right? How long are we really? Like from November. So for me, in my opinion, we're only like 3 months really deep into the bear market, but you could argue also like half a year already. Okay, depends, but let's say 3 to 6 months in. We're 3 to 6 months in the bear market, where the boring phase, right? But I'm already having like sometimes temptations or thinking like, should I really stick to the plan? And I know I should still stick to the plan because I've set it up myself, and I always know I should stick to my plan. But still, you can have emotions on the side. I'm not listening to the emotions, but I can imagine that if I'm having these emotions right now, that a lot of people will have them too, and a lot of people will actually also find it hard to stick to their plan. And I think that is the part where most people mess up. Where are the views gone despite you are a beast? I mean, it's just that people leave the market. People leave the market. Interest has been fading away. But yeah, I mean, I've said it also in previous streams, right? I do not like for the people that are watching now. I just think it's better right now. It's just a tighter community. It's gonna be better, I think. By the way, also I've seen that the platinum group bot is not working anymore. I've seen some people wanting to join, but they could not because the bot is not working anymore. So that's unfortunate. I will try to get it back up today, actually, or maybe tomorrow. But yeah, then you can join the platinum group again, where I'm sharing all of my trading updates. By the way, I have set all of my orders. I've showed all of my orders. Didn't share yet that first order has been getting entered. So let me quickly update that. Say screenshot like and share it. There we go. Just shared an update in a platinum group. It's solid advice. It's hard to be patient. Do you ever trade smaller time frames, or you used to but didn't anymore? I mean, for me, this is already kind of smaller time frames. This is what I'm doing over here right now. But for example, when you're talking about the 15 minutes and you're talking about, are we gonna bounce from of this level now, or like, I don't know, continue to the downside? This I don't really know. It's a lot harder. Now what I did too, 2 months ago, or yeah, it's been like 2 months ago. Yes, 2 months ago, I did a scalp Bitcoin on the 1 minute time frame and followed the trend and used a scalping strategy with some indicators and also my own intuition, and that went pretty well as well. Okay, but I just did that for fun on the side myself. I didn't share any of that, but that was pretty fun to do. But these were like very, very quick scalps, like very quick, literally in and out in 2 or 3 minutes. Only if I saw like good opportunities in the trend. But like, so yeah, it still works. I mean, you can still definitely scalp, but I just find scalping you really need to be dialed in. Also, I mean, if you want to be scalping, you really need to be focused. You've gotta need to have a good routine. You've gotta have a clear, healthy mind. And all of these small minor factors, like for example your health, etc., you really need to optimize that as well. I would argue, because intuition with scalping, I think, does definitely play a huge role and a huge part, and so health needs to be on point also. And you need to be dialed in, really focused, really paying a lot of attention and a lot of time. So that's why for me it's easier to just stick to the higher time frames and follow a plan that I've set up and just stick through that, analyze on the larger time frames and anticipate larger moves. It's easier. Scalping is possible, but just need to dialed in. Yes, 100%. It's logical. When price is down, people hate looking at the chart. When it's up, they love it. 100%. 100% true. But also at the same time, it's actually pretty interesting because always you can have a look into my views. But always, for example, during these pumps here, people don't care as much. But then during a dump like this on October 10th, people care. Then during the dump, people will care. They think, oh, what's going on? Why is my price crashing? Why is everything crashing? And then when everything is bumping, everybody is like, ah, it's all right. It's all right. I'm making money anyway. I shouldn't be watching this guy because I'm making money anyway. So who cares what this guy is telling? And then when it's dumping, people think, oh, what the fuck is going on? And they want to know and they watch the videos, you know? But right now, because we have been down for long enough, people lost an interest, like all their interest. Anyways, 5 more minutes left until the FOMC meeting. Let me load up the stream so I can show it in our live stream, and we will be watching that live. Again, why I think this will be so important is this stream is because US oil prices have been rising, and because of that, probably the US inflation will be rising too. And if the US inflation will be rising, it will be less of an incentive, way less of an incentive for the Fed to cut interest rates, which will be bad for the risk on assets. Okay, so I want to see the comments from Jerome Powell on the rising oil prices and rising inflation. I'm not 100% sure if he's going to comment on that, but I do think so. It would make sense. So let's see. That will be one part, which I think will be pretty important. Also, probably is just going to say we've got everything under control. We want to remain to keep. interest rates like this, etc. But let's see. I mean, that would be a bearish thing, right? If he says that we want pretty much interest rates to decrease, that would be the bullish part. We're gonna see that. Anyways, also make sure to push up that like button. Let me reload this page. No rate cut in 2026. Ah. So yeah, they do see. This is like the Fed summary report. They do see that probably inflation is gonna rise. So yeah, that's bearish, right? They do project that. GDP, that's good. So yeah, they still think economy is pretty good, pretty strong. Inflation will increase, but they are not that worried about it. Pretty interesting. Okay, so just 2 minutes left. Minute left. Let's see. All right, let's go. A little bit late. Turn it on.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American. FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods. And on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
The consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller. they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. That, you know, to your point, if we have high, if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah.
About
so there'll be an offset.
Offsets, yeah.
So that's true. We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much of it happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision-making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had, we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations, and so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%, and I think it's important that we do that. Very important.
Nick.
Nick Timmeros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well, as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices are the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates, or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, we're a full percentage point above 2% for some time, and that's a concern. We need to get back down to 2%, and we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the